what's been happening on Reddit and in social media and in the marketplace has never been seen before. Okay. And it tells me I'm actually shocked. I mean, here I am having followed markets for over 60 years to see this young generation of people making so much change in such a short period of time.
Hi everyone. Before we get started, I have to plug a few quick things. First of all, my book, Brexit, The Establishment Civil War, is now available to order. You can read some chapter previews by following the link in the description below. Our sponsors, ExpressVPN, get 35% off 12 months of ExpressVPN and get 25% off podcast hosting with Podium. Finally, if you're watching this on YouTube, please go check out odyssey.com instead. We are hosting all our videos there. If you're a creator, you can move your videos across with one simple click, and you can earn cryptocurrency simply by watching videos and use it to tip your favorite creators like myself. So please check that all out if you want to support the show. Anyway, here's the podcast. My music is all from the 60s. So, hello everyone and welcome to another episode of Chatter. Today I have the absolute pleasure to be talking to Carl Hagberg, who is the head of Carl T. Hagberg and Associates and publisher of the newsletter that you were just informing me was founded in 1994 called the Shareholder Service Optimizer, about how to get value for money from your shareholders. So Carl, welcome to the show. Thank you very much for joining me.
Thank you. My pleasure.
No problem. So, obviously, I came across you when I saw your Ask Me Anything on r/Superstunk on Reddit, and I was just enthralled at some of the stuff you were saying, and wanted the opportunity to speak to you to myself. So I'm really pleased that I get to do this. So I'm just going to dive straight into the questions I've prepared, so we get as much time, as much out of the time as possible. So in another one of the Ask Me Anythings, I saw Wes Christensen and Dave Lauer talking about numerous occasions in history where the short interest or short interest or the number of shareholders that voted on a company in a shareholders meeting was over 100%, and some occasions that they were quoting were well over 200%. Why has nothing been done about that yet? That seems like a huge thing that should probably be addressed.
Well, yes, and and I mentioned in my previous interview that around the 2007 2008, when we had the financial crash and people were selling financial industry stocks short like crazy, the SEC did step in. They put in some temporary regulations. They passed a rule just before that was called, it's still in force, okay, and it's a Reg SHO, and it was designed to make the short interest more transparent to people. And so they did a few things. And then when the financial crisis hit, they passed some temporary regulations. For example, they forbade people to sell short certain banks, and certain financial institutions, because they were putting them right into the dumper. I mean, some of the biggest banks in the world could have crashed because of these short sellers selling constantly shares that truly didn't even exist. They just kept selling into the market. So they did that. And then they took a breath. And in 2009, I mentioned this the other day, the Inspector General for the SEC of audits did, it must be a 50-page survey. And they said, yes, we're not monitoring these things closely. We should monitor them better. And we should open cases and track them until they're resolved. And well, what happened, and actually Suzanne Trimbath mentioned this in her podcast too, that was a time when everybody was looking at risk in terms of that day's market value. So they would track the gigantic items, but the thousands and thousands of small items would somehow just get lost in the shuffle and get ignored. And so they made 11 recommendations, and the SEC only adopted one, if you could believe that. And then since then, they have been, I've written to them, my God, they must be sick of hearing from me. I keep writing to them and saying, you must fix the abuses in short selling, mainly because back then we weren't seeing what we've been seeing this year, okay, and the end of last year, but we were seeing overvoting, massive overvoting, and you didn't know whether the real voters were getting their votes in or fake people were getting their votes in, you know? So we've written to them numerous times. Public companies have written as well. And I guess it wasn't such a big problem. Well, this year, of course, it's becoming a much, much bigger problem. And short selling too, it tends to be cyclical and it comes to go in waves. And there's actually another reason where short selling's kind of abated. And that is that a lot of the most active investors and the biggest plungers and gamblers, okay, they found a better way to make money, which was to put companies themselves into play, to take them over, to take over the board, to put the company up for sale, to merge with another company. And so you could make more money taking apart companies or selling them or merging them than you could, and in fact, which always made the price go up. So it became a lot riskier to be a short seller when you had activist investors who were basically auctioning the whole company off. You know, the whole company was up for grabs there. So that kind of made the short sellers go quiet, relatively quiet, until what we are seeing today with the so-called meme stocks, you know, and so now is a different day, and so this is very timely, and it's time to be getting down to cases and fixing this. Okay,
Hmm.
so that's a long answer to a short question, but that's my answer.
No, that's all right. I mean, this is the beauty of the format is that you can take as long as you like to say whatever is required. And
You may don't say that. You may regret it.
no, I doubt it. Don't
Okay.
worry. So, talking about the 11 recommendations that you mentioned that were made to the SEC, was warnings about problems with failure to delivers and things like that. And you said that they only have one recommendation put in place, and that was only temporary, as far as I'm aware. Now, I,
But most of these regulations were temporary,
hmm,
okay? And so I think your question is about fails to deliver and I guess the harm they do. So I guess we should start with the fact that fails to deliver are just a fact of life. Every day there are fails to deliver, and Suzanne covered this too. There could be a lot of reasons: missing a bit of information, you know, the wrong broker, the name, you deliver the wrong stock, and it doesn't match the CUSIP number. So most times, it's a bookkeeping mistake that creates fails to deliver, and they're there every day. And as Suzanne described too, they check them off, they resolve them, and most of the times they get them fixed. But when they arise from naked short sales, and when the naked short sales start to pile up, so that they're not just 50% of the outstanding shares, but 100 or 150 or 200%, well, now fails to deliver are a huge problem because people have sold all of those shares, but they didn't deliver them. And so there's liability. And guess what? Where do you get the money? Okay. Until you can get the shares and sell the shares and give the money back or give the shares back, you've got enormous liability. So now suddenly, with what's happened late last year into this year, the fails became a gigantic problem. And so DTC, for example, quite properly went to what's their name there? Oh golly, yeah, Robin Hood, and said you got to put up 150 million of collateral or something because they had open trades that weren't settled that were on the order of 150 million dollars worth and maybe more. And so when fails to deliver get totally out of hand, as they did several times this year, they became tremendously risky to the financial system as a whole. And it's actually similar to what happened with that quasi bank there that lent all that money and then lost track of it all. You know, so that's why fails are a problem and why people need to track how big that problem is. And when it starts to get into super large dollar values of failed deliveries, there's risk to the entire financial system. Because remember, you can't sell something unless there's a buyer. Okay, but unfortunately, you can buy something when there's no sellers if you borrow all the stock and you create all these fictitious transactions. Okay, so that's the answer to that.
No, I mean the thing that really strikes me is that when you're talking about the failures to deliver, and you're saying, okay, that could be like up to they're creating naked synthetic shares to the tune of 50, 100% of the number of shares that exist in a company, and then like no one produces them, so they're basically it sounds like the biggest con in the world. And I
Right,
can't,
right,
like honestly,
right,
I have trouble trying to explain what is happening here to people, because I'll tell them exactly what
right,
you've told me here,
right,
and they maybe not quite as articulately, but they can't believe it. They're like, that can't be right. Like you've
right,
misunderstood
right,
something there.
right.
Like, why do you think this level of fraud essentially is accepted?
Well, let's not go back and call it a fraud right off the bat, okay? Short selling is currently legal. It's currently
Hmm.
legal to sell short, and some people actually think it's a good thing. I don't agree with them, but they think that. And so what's the problem? We need to explain to the SEC why this is so bad and how dangerous it is when it gets to heights like this, okay? And why we need to have a stopgap, a cure in place so that this won't happen, okay? And but you're right, it's hard for people to believe, partly because it doesn't happen every day. Now we're in a particular period where this is happening like crazy, and I think even some of the regulators are spooked by this, and it's about time. And it's not that hard to understand. You know, actually, I had some real estate transactions. I tried to buy land next to my house one time so I could expand my house. And it turned out that when we did the title search, the owner of the land had sold the land to 5 different people, all banks. And the banks gave him money, gave him a mortgage, which he never bothered to pay, by the way. Okay. But they didn't do their due diligence. They didn't realize that there was only one piece of land there, but it had been mortgaged 5 times. And that's sort of almost precisely what's happening in this current scheme of things, because nobody is keeping track of who the real owner is, you know? And so it's like, same thing. You couldn't sell your cow to 6 different people, because it's a cow and it either shows up or it doesn't. But a security that you let floating around here in limbo and you never pay the piper. That's what's happening here. And so it shouldn't be that hard to understand. But here's the other thing, and why it is hard to understand is the regulators. They're willfully blind. Okay, so when you try to tell them this, their eyes glaze over, their ears stop listening. They start probably singing a song to themselves to eliminate the boredom of having to listen to this, and they think it's all baloney. And so they go, oh, this is just ridiculous. How could such a thing happen? How could you sell, if you have 100 million shares, how could you sell 250 million shares? And they think it's a made up story. So some are willfully blind, but most of the regulators are the regulated. If you look and you say, well, who's in charge of FINRA, the Financial Industry Regulatory Association? Well, it's the CEOs and the CFOs and the chief accountants of all of the companies that are being regulated. And the third thing, of course, at the end of every story, there's always, it's the money, stupid. People are making billions of dollars lending these fictitious shares over and over and over again. And many of them are honest and upright people. Some of the biggest villains here are mutual funds. They make significant amounts of money by lending shares into this market, okay? and then never, they don't want to reclaim them because they want to keep on collecting that money they get every day. So that's the real answer. It's a combination of being willfully deaf, dumb, and blind, being just not wanting to internalize what a mess there is because they're not sure how to untangle it, even though it isn't all that difficult. It'll be difficult for the people who are skimming off all this money, but it won't be difficult for the SEC to fix it if they have a mind to. So that's the real answer. Okay. There's a name, they call it regulatory capture. The industry itself, the financial industry, banks, brokers, investment funds, they basically have captured. What does the SEC know? These are kids who come from law school. 80% of them are kids that are a year out of law school. And what the heck do they know about anything? You know what I mean? So it's not that hard to pull the wool over their eyes or to completely flummox them with a barrage of baloney. So that's the answer to that one.
Yeah, and I guess if they try and look into something, they're going to be met with the best team of lawyers that money can buy, as opposed to whatever the SEC has at their disposal.
Well, that's part of it.
Now, you're also speaking very much to a concept called financialization, and so yeah, financial capture of regulatory agencies and of government bodies, which is something that I spoke to Nicholas Shaxson, the author of The Finance Curse, about. So if anyone wants to hear more about that, I'll put the link in the description below. So one of the reasons that I asked you on was to try and get a handle on this idea of reconciliations, because this is something that a couple of people have discussed around this topic. So
Right.
what happens when we get to, so if we take a fictitious company, and we call it Fake News Inc., and they have got to the shareholders meeting, and they've realized that a few weeks maybe in advance or a week in advance that 150% of the shares have voted. And then you mentioned
Right.
that they go into reconciliation in their dark and smoky back room. What goes on in there? Because I can't get my head around what happens. Do they just agree that
It's
50%?
so simple.
Yeah. Okay. So
Right.
please.
It's so simple. They do as they choose. They cast votes out and they take them out and they lower their vote until they are not going over 100 anymore. Okay, and so we prove again we have 1 million shares. We voted 1 million because I took back an extra 1 million. But we don't know who they took them from or whether they were the right people to take them from. And in many cases, they're taking them from the wrong people. They're taking them from individual investors who have accounts, who paid cash for their shares, okay? And then they're giving the votes and the credit to people who've loaned their shares out. And so we don't know, and no one knows what to do in that dark room. I've been in some of those dark rooms, and some people would say, "Well, we're going to take out all of the latest votes cast. We'll just start subtracting today's, yesterday's, day before yesterday's until we get under 100." Well, these are the people who legally are the most entitled to vote. It's the last vote you cast that counts, okay? Not the first one. Some people will vote a month earlier, and then they'll change their mind and vote again and again. But it's only the last vote you count. Cast that counts. So some of them are doing this completely backwards. Most are doing it in a totally arbitrary manner, and they are just casting out names and voting positions, and they go, "Oh, here's I don't know, some little bank in Switzerland. Who knows them? What are they? They don't even know whether they voted or not. Boom, we'll throw them out." So we don't know what they're doing really, and it's totally arbitrary. And the other thing is that the rules are not entirely clear, okay? Because the rules of stock ownership and voting, they all go back to the days when securities were physical items, okay? And I talked at my beginning days in the paperwork crisis on Wall Street, and the debits always had to equal the credits. And if they didn't, you worked until they did. Well, the debits don't equal the credits anymore once stocks have been dematerialized. So you've got these, we call them phantom shares floating around. Who knows where they are? Who knows who owned them? Where's the real underlying share? Where is that lodged? Okay. No one even knows. So unfortunately, yes, it takes place in a dark room in a totally arbitrary manner, and there are clarifications that need to be made to make it clear who has the right to vote shares. Okay, and once you're the legal owner, guess what? Some of the folks from Europe, okay, who were involved in GameStop and AMC, their broker is telling them, "Oh no, you don't get a right to vote." They're saying, "Well, where's my proxy? I want to vote my proxy." No, you don't get that. You have a margin account, and I think some of these people were intentionally setting these up as margin accounts. They may have made disclosure, but some of them probably did not. And they arbitrarily decided, oh, you're in a margin account. You don't get a vote. This is ridiculous. You put money on the barrelhead for 100 shares of stock, you're expecting to get 100 votes. Okay? Not to hear, oh, you have a margin account and you get nothing. Oh, and by the way, I lent the shares to somebody else and I made money, but I didn't share any of that with you. So take a walk. So those are some of the problems that need to be addressed in this new era,
Yeah.
I hope.
No, that's something funny because there's something I was actually discussing with my best friend like a few hours ago because I asked him had he voted yet because I have my shares split across eToro and Stake, which are two platforms you can use in the UK, and he is on Trading 212, but Trading 212 have not allowed the votes yet from GameStop holders. So he was like telling me that there's a lot of pressure, but and it just seems like a ridiculous thing. Like if my broker can do it, why can't his? But I wanted to ask.
Right. And you know what? Here's another thing on this, okay? I'm sorry to interrupt, but some of these, throughout Europe and the UK, many people don't bother to vote at all, okay? The shareholders themselves don't get this material, so they don't even know there is a vote going on in many cases, okay? Unless it's a famous event. So they don't even know this. But meanwhile, their custodian bank, the clearing company, or the custodian bank where the shares are kept, it's too expensive to them to participate in the voting system. You need to have an account at Depository Trust Company in New York if you're a U.S. listed stock, and that's expensive. And they say, well, I don't have that many trades, I don't have that many customers. So some have a chain of banks. They call them correspondent banks, and so sometimes they can vote, but typically until 2 or 3 years ago, we almost never, ever, ever saw a foreign bank or custodial institution cast any votes in a U.S. election. Okay, unless of course it was a Fortune 500 company and a lot of shares. So that infrastructure, we think our proxy plumbing is broken over here in the U.S. Oh, in the U.K. and Europe, when it comes to voting, there's no plumbing at all. There's like a giant clog, you know.
Well, I mean, London is quite famously the world center of financial corruption and money laundering, and just not a lot of particularly. Yeah, well, I mean, the Russians are laundering potentially hundreds of millions through there.
Guess what? By the way, that's another one of the biggest scandals that ever happened in the world of finance. And I must say, this was largely covered up by the SEC. But billions, hundreds of billions of dollars of Russian money was laundered using ADRs, these horrible old American depository receipts. And they would move them from one country to another, and then they'd end up in Cyprus, and suddenly they'd be turned into cash or a condo somewhere. You could guess where, too. It was one of the favorite spots to have your condo. But hundreds of billions of dollars were laundered through securities markets and clearing companies. Again, willfully blind, turning a blind eye to where all these shares were going. Okay. So that's another program, though.
Yeah, but I mean, there's so many examples of situations like this. Maybe not with ones with quite the size of money flowing around, but you could, like, every major bank or institution has been involved in in some kind of level of either law breaking or questionable practices that have made them a lot of
Right.
money, and they've kind
Of
of
course.
just got away with it for the whole of human history because of
Right.
the amount of money. And
Right.
this situation is
Right.
actually finally bringing some light to it. And I don't know what's going to happen,
Right.
but we'll see.
Right.
Um,
Right. Right. This is relatively minor compared to some of the other, the money laundering, especially. This is like a little bagatelle, and it only came to light because of the GameStop and AMC trades and Hertz and to put it in perspective, it's scandalous. It needs to be fixed, but it's actually relatively minor in the scheme of things because a lot of people think, oh, my votes don't have any value anyway, but they're wrong, of course. But it's not. There's no comparison between what happened in the world of money laundering and what's happening in the world of vote laundering. Okay, vote washing, we'll call it. All right.
hmm, hmm. So, is there a rule that says that there must only be 100% of the shares voted? That is there or is it just sort of a red flag for a company, or is there a specific reason that they go into reconciliation and say we have to have 100% or less?
Well, in other words, every position. Okay. See, here's the thing: in the aggregate, sometimes 100% of the shares are not voted, but still, there are people who weren't entitled to vote who did, and people who weren't entitled who didn't. But so it never gets discovered until each particular entity that is the custodian for the shares goes over 100. Then they go into the dark room and fix so they're under 100. Okay, but in the high days in the 19 what decade am I looking for here? In the 19 aughts, so I call them the noughties, the 19. What am I saying? In any event,
1900s?
yeah, the late 1900s, let's say. The Where was I going with this? People were going way, way, way over 100. They would go to their annual meeting, and they would get the report because they hired somebody to count up the votes. And that person would tell them, oh, we have 200 million votes. And they said, well, I only have 50 million shares. How could this be? So back they would have to go to the dark room to start crossing things out until they could get down to the 50 million. Okay. So, but it doesn't happen that often because normally only, if 80% of the people vote, it's a lot. And it only gets that high because institutions here, institutional investors are required by law to cast votes because the Department of Labor said your votes have value and you must cast your votes. So big investors always cast their votes. Little investors often don't cast their votes. So it's rare that people do actually go over 100. Okay.
Hmm.
So that's that one.
So the thing I'm really curious about is sort of what happens now when we get to next week and we have the GameStop shareholders meeting, and they, for example, say it's just 120% of the float is has voted. Is there a historical precedent for the shareholders revolting if some of the votes try to be like cancelled out, or I don't know what the mechanism is. So say you're a shareholder
No.
and you have heard that your
Right.
vote hasn't been counted because it's been struck off for whatever reason, it's been
Right.
crossed out in
Right.
the dark room. Like,
Right.
what reconciliation do shareholders have if they find this out, or do they ever even find it out?
They never find it out because it gets fixed before the meeting convenes. Okay. You can't really have a meeting and say that you have 110% of the shares voted. Okay. You're lucky if you can say you have 80% or 79%. So, yes, I mean, and that's another reason why this problem doesn't get the attention it probably deserves. It's hiding in the background and the votes get washed before the meeting convenes. Okay. So, uh, once people were wise to this, and most people are usually using professional tabulators, so they're not going to send in their vote that's 10% over what they're entitled to vote. They fix it. They go back to their clients and say, there are some mistakes here. Fix it. And then the client comes back with a better answer. Okay. But we don't know whether it's how they got to that answer, but it's as long as you didn't go over 100, you pass the test.
So one of the things that people have spoken about is a way that there could be, I don't know, some sort of way to combat or counter this idea of 100% or more of the shares being voted is if they issued a dividend to shareholders. And that would be one way of attempting to kind of call the bluff in a way. Like, what's like, is that something that's real, or how powerful can that possibly be? What's the deal with that, basically?
It's wishful thinking, okay? Because many companies who pay dividends get in the same bind with the systems that keep track of the dividends are pretty good ones. They are the debits and credits match. If you think you're getting $100,000 dividend check in the mail, you don't want to be getting an $80,000 one. So those systems are pretty good. They're quite good. But they're different than the systems that are used for voting. And that's the problem. That's the proxy plumbing issue. We have pretty good plumbing. We have excellent plumbing when it takes pushing money through the system. But when it takes pushing votes through the system, no. We got a lot of smelly clogs and log jams and things like that. And so, no, just declaring a dividend is not going to solve it. And I know you had asked about paying in cryptocurrency. That's not going to solve it either. And guess what? Me personally, I say I want to see the credit in my brokerage account. Or better yet, send me a check so I can run to the bank and cash it and spend it. So, no, cryptocurrency unfortunately isn't going to solve the problem either. Okay.
I mean, the proposal from some people had discussed the idea. It wasn't specifically like a cryptocurrency dividend. It was what's known as an NFT, which is a non-fungible token, which is basically a digital certificate that cannot be replicated. And the theory went that if they could make exactly 100% of the shares worth of these for all of the individual shares, that then when they gave them out and some people didn't get them, it would expose the fact that there was more shares in existence than should exist. But you're skeptical
that won't happen.
No? Okay.
It won't happen. People who are entitled to get dividends will always be getting them, okay? But this is the problem. There, you prove to the outstanding shares, to the penny, and you pay people exactly the number of shares multiplied by the rate, and that's how much money you pay out. But the voting system is a different system, and as we know, nobody is keeping track, okay? If I lend my shares to you, and you lend them to John Doe, and John Doe lends them to Mary Smith, okay, and nobody has ever tendered any of those shares and transferred them, there's 4 or 5, quote, sets of shares out there that aren't written down. Nobody's written down who loaned what to whom and on what day. So it's a mess. It's a total mess.
So one of the things you discussed there is that there is quite a lot of things that the SEC could do in order to prevent situations like this arising, to stop the proliferation of naked short selling, and basically to combat all of the things that we're seeing with GameStop, and we have been seeing with loads of other stocks since, like Eagle Tech and Overstock and all the other companies that have suffered because of these practices. What do you think would be the cost of actually enforcing those regulations? Because part of me feels like if you were to suddenly go into Wall Street and go, hey boys, everything's going to be totally transparent and we're going to know exactly what's happening, and we're going to make it a 100% free and fair open market, I feel like that might cause an economic crash. That's just
no, it wouldn't. No, it wouldn't. No, I would be more fearful of a crash if people were to lose confidence in the integrity of the systems themselves. Okay, as I say, if we weren't getting our money, then people would be up in arms. But if it's only votes, people go, oh well, what the heck? I wasn't too. That's not such a big deal. So no, it's not. It's not going to be like that. But they can fix this with really basically the stroke of a pen. They do need greater transparency. One of the things that the SEC did way back when was to say you need to disclose your short interest, your open short interest, and then we need to report it, and somebody needs to monitor it and say, wait, it's too high. You need to reconcile here. You need to straighten this out. But there's no real mechanism. There's no enforcement of that. Okay, so it would be easy. It's easy to know how much the open short interest is. Okay, every broker knows, whether they owe something or somebody owes them something, but they don't make it easy to find out. But it is easy to find out. Okay, and then all you really need to do, and my understanding is that this is what they are either doing or planning to do in the UK, and that is that after 5 days you must close out any open short positions that you have by delivering the shares. If you don't have them, you got to go into the market and buy them. If you don't, if you delay, the clearing corp will go into the market, buy the shares, and debit your account for the cash. Okay, and problem solved. And going back to what I said at the very beginning, fails to deliver are part of a normal. That's part of a normal background noise. And so you can make allowances for the dollar amount or the percentage of the outstanding. You say, well, if the open short interest is a 10, 15% of the outstanding, well, the sky isn't necessarily going to fall in on us. But if it's 100%, 150%, yes, the sky can and will fall in on you, okay, if bad things happen. So that's all you really need to do, is to have a rule that says after 5 days, if your short interest is more than 5% of the outstanding, or 5% of the dollars worth outstanding, you will either buy in, or we, the clearinghouse, will buy you in and debit your account for the cash. Okay? And so it's not that complicated.
That sounds like a really positive move, actually. I hadn't heard that that was going to happen in the UK. I will definitely look at that, because they're normally incredibly resistant in the UK to any sort of regulation of finance, especially post Brexit. That's meant to be like our selling point, that we're going to be a slightly deregulated market off the coast of Europe. So what other things, you mentioned that there's a number of things that we could do to stop this situation arising. So one of them was to disclose the short interest. Another one would be to force hedge funds to cover their short positions in certain circumstances. Could you give a few more examples of things that could be done?
Well, I think the thing that needs to be done, and that we're starting to do here, using social media, is to use the power of people who know, who understand this, okay, and who have figured it out, to make some noise and persist with the regulatory bodies. And as I said during the last session I had, I'm quite impressed with Gary Gensler. He's a very smart guy. I think has a very, very high integrity, and he is a person who has a history of wading into these mucky plumbing issues and straightening them out and replumbing them and cleaning them up. But on top of that, I guess this is probably where I would spend the last few minutes of my time. What's been happening on Reddit and in social media and in the marketplace has never been seen before, okay? And it tells me, I'm actually shocked. I mean, here I am, having followed markets for over 60 years, to see this young generation of people making so much change in such a short period of time. And I made my little list as to why this is, and part of it is that you have a new generation of younger, better educated, pretty financially literate and numerate literate, the numbers literate people who can see what's going on, and then of course, so they get it, and they're fans of what they're doing. This is the other thing. If we looked at what's the common thing that happened with GameStop and AMC and Hertz, they're fans of the company. They want to see the company do well, and so they're banding together to say, "Hey, this isn't right. We're putting our money behind you." The other really fascinating thing to me is my grandkids tease me because I was sometimes referring them as gamesters, but they're gamers, okay? A lot of the people here are gamers. And lo and behold, because they were smart and they know how to play games, they beat the short sellers at their own game. They beat the pants off the short sellers. A relatively small band of savvy people, okay, I just yesterday, the 28th of May, was an article in the Wall Street Journal, and it said that so far this year, short sellers have lost $9 billion just in GameStop, AMC, and Hertz alone. $9 billion, my friend. That's You need to pay attention, okay? And the short sellers, by the way, are not very good gamers. Their game is usually bullying, It's moving into the market, spreading rumors, pushing your money around, borrowing and reborrowing. Their game is really not a terribly clever game, okay? So here, a band of maybe 200,000 at most, okay, gamers put their money together and use social media. A $9 billion loss is quite a spanking if you're a typical short seller, okay? And so, as I say, beaten by relative newcomers to the market who simply outgamed them, So I am quite impressed. And it's funny, Suzanne Trimbath was talking about a pitchfork army, okay? And it is like a pitchfork army, but a peaceable one. They're coming with pitchforks to muck out the stalls of Congress, and the SEC, and say, we got to clean up all of this manure here and clean house and get some decent plumbing in here. And so, yeah, it's like a pitchfork army of people. Someone else has been a lot of people have been referring to these people as vigilante investors. I like that too, because they're vigilant, they're paying attention, and they're not running away and hiding when, a couple of blowhard billionaires blow back at them. So, in any event, I feel pretty optimistic that it's long past time for a change. And I think this new generation of people, and the other thing is that they're interested in voting outcomes. For the past 50 years, individual investors have not been terribly concerned about typical proxy matters, and most of them were dull. Oh, to reappoint the auditors, oh, reappoint the directors. Oh, no, you didn't have any information to make a decision. But now we're talking about social and environmental issues. And so people are saying, hey, voting is important here. We have a climate crisis, we have an existential crisis with climate, and people are trying to vote against climate change remediation. So it's different. The importance of voting has gone up a great deal in just the past year or year and a half. So I think that's where I come out. My hat's off to the gamesters or the gamers or the vigilante investors. And I guess I've always been a bit like that myself. But I do want to say people do need to exercise caution. So far, the gamers have been pretty good at this. I mean, many of these stock prices have are so far in excess of their extrinsic value, or their intrinsic value, I should say, it's going to fall. Okay. So if you're a gamer, you say, well, let me make sure that I find the right moment, that I hit the sell button before I start getting into the red here. So there is an element of gambling and of speculation. And so people who want to be, and it's not investing. So people who want to be investors need to think like investors. You have to say, yes, I got my game hat on today, and I got my earphones, I got my microphone, I'm ready to rumble, and I got my trading app. But you've got to say, I got to also have my investor hat on here, where I'm looking and I say, what could this business possibly be worth? Okay, whether it's movie theaters or games or car rentals or whatever. And you can usually come at a reasonable answer for that. And you can have your wildly optimistic scenario and your moderate one on your worst case scenario. That's what people need to do. So they need, while yes, they want to be nimble and quick, they also need to think like investors. But you still think of this because it is something of a game,
I
for
yeah,
sure.
I love your
So that's
analogy
it.
there that it's a game and it's all gamers playing this game. That's beautifully put. I've been trying to find a way to put that in the book that I'm currently writing, so I'm 100% stealing that. But I quote you, so don't worry. Uh,
Okay.
and
Okay.
it's so beautifully positive. Like I can't stop smiling when you're saying these things because because I don't know. I spent a long time thinking not that much of my generation. I thought we were all lazy. We didn't really do much, but
All right.
I don't know. The last 6 months have proven to me that we're capable of doing quite a lot when we actually care about something. Um,
There you go. It's,
yeah.
it's amazing. It's amazing. And social media is really the key to this. I mean, how could you organize? Look at how many people you can organize in
Hmm.
in podcasts like this. And then there's chatting back and forth and debate. And so this would have been impossible before. The old annual meeting, you had to get in your horse and carriage and drive to
Hmm.
Delaware, and nobody came. And so it's definitely a different day today. And I have to say, I'm really in awe of what has been done in just the past 16, 18 months. And it's not going to go away. I think now the vigilante investors, they're not going to go away. So
Hmm.
anyway,
Yeah.
that's it.
Yeah, I mean, the someone said the other day on I think it was one of the Reddit threads I was reading. They said that the gamers always try to go for the high score. Um, so like yeah,
Yes,
everyone be a little careful. But do you have time for
yes,
one more quick question here, Carl?
sure.
Lovely. So the last thing I wanted to see to ask was whether you see some genuine reform coming out of this beyond. I know we've seen some SEC, DTCC like regulations put in place, but do you see like major root and branch reform coming from this of the financial system? Maybe like a few little regulations around short selling. Like, what do you see coming of this whole saga?
Well, let's be clear. Most of our financial system is in wonderful shape, okay? And in fact, this is an important thing. I was actually going to start out by giving you a little bit about my history and my background. But if you look for my entire lifetime, for the past 50, 60 years, stocks have returned more money. It's been the best investment known to man, except maybe for baseball cards, collectible baseball cards. And so the total return from the stock market, it's just been an engine of tremendous wealth. And it works, by and large, it's worked well. So we need to keep this all in perspective. You know what I mean? So I'm happy to see right now, a year ago in the US, individual ownership of individual stocks was at its lowest point in like 60 years. Okay.
Really?
And yeah. And now, last year, I think there's something like maybe 10 or 15 million individual investors came into the stock market. And many of them did so not through mutual funds or iShares or ADRs, but by buying stocks in companies that they know, they like, they understand the product. It's the most basic. This is like the Warren Buffett principle of investing. Buy companies that you know, that you like, where you trust the management. So I feel extremely optimistic about this. I think the economy's going in the right direction. I think people are rightly looking at stocks as an engine of wealth, okay? And there's another issue here, too, by the way. That most of this enormous wealth that's been created by the stock market has gone to the 1%, okay? To the chairman, the chief executive, the chief operating officer, and they collect all the dividends. They collect all the stock price appreciation. Individuals were sitting on the sidelines with empty pockets. So I'm happy to see individual investors coming back into the market. And as long as they keep their heads about them, as I say, participating in one of the longest running and most productive stock markets ever. Just don't make the mistake that individuals always tend to do. They always tend to keep their losers and sell their winners. They always tend to buy high and sell low. They never like to admit that they made a mistake. You really, stocks don't know you own them. They don't know, and they don't care if you love them or not. They are subject to market forces, so you have to pay attention. And the other thing I would say at the very end, I say this to everybody when it comes to investing. I tried in my first outing here to try to make things simple and to, focus on and think as an investor. My favorite expression is trees do not grow to the moon. Okay. And so when you see stocks going higher, 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 you got to say, wait. I'm sure. I saw these three stocks. I think they went up 1,400% in the past maybe a year. Okay, the past 12 months. Well, that's it's too good to be true. So you need to be putting your head into the game as well, and remembering that no, trees do not go to the moon, and the higher you go, the further you have to fall. So sometimes it makes sense to take some of your profits and move on to a different kind of investment. So anyway, that's it. I end up being very optimistic about all this, and I'm happy to see this new generation of people getting into the stock market, getting involved, getting engaged, and becoming activist investors, which is good. So that's it.
Well, your positivity is truly infectious. It's a wonderful and exciting time to be alive. So, Carl, I want to say thank you so much for your time. Everybody, check out Carl's newsletter, his website, the AMA he did with r/Superstonk. I will put links for everything and anything else we discussed in the description below. So, Carl, thanks very much.
It was great fun talking with you, and be well and keep it up, okay?
Thank you.
Thanks so much for listening. If you enjoyed the show, please subscribe, follow me on Twitter, or sign up to our mailing list. Thanks a lot to our sponsor, ExpressVPN, the #1 most trusted VPN. Get lightning fast connectivity with servers in 160 locations across 94 countries. Keep your browsing privacy safe with ExpressVPN and get a 35% discount on 12 months of ExpressVPN when you follow the link in the description below. Don't forget my book is now out and available to order on Amazon and on bookshop.org. That's Brexit, the Establishment Civil War. And most importantly, thanks for listening. We'll see you next time.